Joining me at Post 9 with how investors should be positioning right now is KKR's balance sheet CIO, Henry McVey. Henry, great to see you.
Great. Nice.
You're always kind of traveling the world. You span asset classes and regions and types of investors. I want your assessment of kind of what this market's been contending with in the last couple of months, meaning we had this crescendo of sell the dollar, sell bonds, sell equities. It all kind of built to a climax. We're rebounded a lot from there, and some of those things have gotten better, and some of them have kind of been sticky. What is that about, and are we stuck in it still?
Okay, well, I think we're into the grind phase of this recovery. Yeah. So let's go through the positives. One is oil's a lot lower. That affects the consumers' wallets and pocketbooks right away. Two is rates are actually lower since President Trump came into office. Sure. And when we look at our models, a slightly lower dollar actually helps. The offset, and then the final thing is there's no net supply. I mean, everything that you've been talking about, the very few IPOs, have been most of their debt financings that we see are refinancing. So typically when you have a real problem, there's a glut of some poor security in the market. That's not the case right now. The negatives, I would say, are things to keep your eye on. Number one is you can't fix a current account deficit without fixing the fiscal deficit first. And so that has created the consternation in the market that you've talked about. The second thing, and we put this in a piece today, is we shouldn't forget one of America's crown jewels is its services industry. Actually, we would estimate the profitability of the $300 billion services industry is actually greater than the current account deficit, the trillion on goods. I think that maybe gets missed.
The services trade surplus.
That surplus is a huge number. And when you look at the jobs number that rolls off every month, we really have a great economy in the services economy. So as we're fixing the goods deficit, we need to make sure that we don't knock down the services economy.
Why would the kind of services trade surplus, the really strong position that our financial and technology media companies have globally, why would it be at risk if we're trying to fix the goods?
Well, I think this gets to what I hear. I travel all over the world, and you report on this, which is you definitely have some consternation from global allocators. Let's go through their April, which is the dollar went down, treasuries went up, and equities went down. And then their liabilities, which are local liabilities in Canada and Japan and Europe, went up faster than what they thought. And that kind of hit some risk alarms. So we need to make sure that we can also not only export goods, but we can export services, particularly around IP, and then I think we're a great economy in terms of capital formation, and that bleeds into financial services. And so as I, talk to different CIOs globally, they're trying to find diversifiers, and that's really what we wrote about today. They want to find things that are non-correlated to the market, and that's been a pretty significant opportunity for what we do at KKR, but it definitely has people, whether institutional investors or individual investors, rethinking that traditional asset allocation.
The markets have celebrated this kind of backpedaling on maximum tariffs and have obviously come down to some level, and there's a pause on most of them. What's your kind of current thinking in terms of where it settles out? What does it mean for growth? What does it mean for global trade and capital flows?
So I think there are a couple of things to keep in mind. One is we view the tariffs probably going to have a baseline of about 10%. I think that's part of President Trump's agenda, and then he'll use the reciprocals to negotiate. We have not been in the recession camp for the reasons I cited. Lower oil prices are a huge tailwind, lower rates, which is a big focus of Scott Bessent, and then ultimately a modestly weaker dollar. That's a pretty good tailwind. So we have GDP about 1 to 2%, and we have earnings. Actually, our models, the same model that was pointing straight down in 2007, it's actually saying that growth is going to be kind of 4 to 5% on earnings. So I take some comfort in that.